All right, after an extreme bout of selling on Monday, so extreme that we kind of expected that it would bounce back up, at least yesterday, if not a little bit more. We got that bounce back up yesterday and today. So now, how far have we bounced up? So I'm going to show you that in context of these different indicators, where there might be some, have we broken through some resistance? Are we hitting some resistance? Because that will impact whether or not we expect that the bouncing is done and we'll continue Monday's move towards the low end of Monday's range the rest of the week, or we'll continue to grind higher like we had last time we had this pullback. So I'm going to break all that down in today's video. We're going to take a look at other asset classes and see how that's influencing things, particularly the dollar and commodities, talking the story that they are showing us right now, and the sectors, like what's driving this risk appetite in the last couple of days. What sectors are leading the way? What asset classes are leading the way? How does that correspond to what has been declining over the last couple of weeks? And does that tell us a story? So I'm going to break that down with our trade idea with the stock that's been its own intermediate pullback that has been converging, and with this move potentially ending its decline, and talk about how to trade that. So let's go ahead and get started. Today is Wednesday, July the 21st, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a second day, closing above yesterday's high, a good bullish move. The near-term line made its way towards the upper reversal zone without quite getting into it, a little dipping its toe there, smidgen in there. The intermediate line dropped, but still is easily in bullish territory. So again, even though it's light pink shading, doesn't mean it's bearish, right? It's about as weakly bearish as you can get because you're still above 60, right? You're still above in the bullish territory. Anything above 60 is bullish. Anything between 60 and 40 is neutral. Anything below 40 is bearish. All right, so that light pink shading is not a bad thing necessarily. Obviously, with the yellow line, we talked about that in Monday's video, that the bullish signal that is, and as we kind of discussed, the possibility for we got the bounce coming out of that. Now the question is whether we are going to bounce up to a new near-term high like we did over here, and like we did here where we got up to new near-term highs, this big, long near-term runs, little dip in between, but not very much fun. This one didn't even have this one had a little dip in between, but not enough to bring the near-term line down like this one did, where we came down there. We had all those, we were close. Remember, on these days we were getting all these filled in candles gapping up and coming down. So over here we weren't doing that. We just kept gapping up and going up, so until just recently. So we'll see if it turns into something more. Again, remember, it's a little bit more bearish than we've been because that near-term line got to a lower level than we've seen this entire rally. So that's what makes this a little unique. That one, the near-term line didn't get in the reversal zone. Over here, the near-term line didn't get in the reversal zone. If it did by just barely. And this one, you can see just barely getting the reversal zone. In fact, this one was the worst. That was the lowest that the near-term line has gotten, down to what, 12.775 on that day. On this day, we hit 12.1. So, that was the worst point. So a little unique in that regard. The momentum line also down below 40 for a little bit longer period of time, similar to what we saw over here when we had that little decline. So some similarities, some differences that are obviously more bearish. The biggest difference is on this go around, the Russell 2000 is a lot more bearish, right? We're a lot more bearish on the Russell than we were over here. Sorry, let me get rid of these. So that makes it a little bit different. As you can see, we're popping back up too on the Russell. But as we mentioned in Monday's video, you get your biggest up days when you're below the moving average. So in the case of the Russell 2000, we had all these down days. You had 4 down days in a row. We had a 2% up day. We had 5 down days in a row, 4 of them for more than 1% or more. So we had a big up day of 3% and follow that up with almost 2%. So now the question is, are we going to start a new trend or back to the red candles, which you can see the last time we had 3% rally to the upside was also kind of in the middle of a bunch of down days, some that came before and some that came after. So and you can see again, going back to our last intermediate decline. This is our last intermediate decline, and let me show you, especially on the SPY. You can see, you had a 2% move coming after some bearish moves, and then you continued. You had some really good, strong moves until the trend ended. This is where that trend ended, and started the bullish run again. So just because we have these 2 up days coming after 5 down days and 9 out of 11 down days doesn't necessarily mean that the bearishness is over. So we definitely need to be wary, especially when we've had 2 real significant gaps to the downside, and SPY also getting significant gaps. Now they're not turning into runaway gaps yet, but you can see you don't get gaps to the downside this big unless you are in intermediate pullback mode. So there's definitely something to keep an eye on with these market forecast charts. As I said again, the Russell, its intermediate posture is still bearish. Like, it's light green shading, but it's still below 40. So it's the opposite of what we saw in the S&P. It is still bearish. It's about as weakly bullish as you could be. And the near-term line rallied, but we've seen that kind of rally before as well. In fact, we got all the way up to 100 on that one, 99, before rolling over. We're going to have that kind of pattern again. That's what we're going to be watching for, especially here in the next couple of days. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. Number 1, you liked our video today. Number 2, you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. If you don't like them, of course, you don't have to click on anything. You don't even have to watch. But if you do like them and you want to let us know, it goes a long way for us with that click. You can even do it right now while you're watching. Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. We do have a special offer for those who do subscribe for free, so check that out when you subscribe. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog, check out our other classes that we have coming up, as well as some of these other things over here on the right. Our Market Outlook live video, this is where we take a look at all the trades that I do in these Market Outlook videos. We continue to trade them. We manage them until we close them. So I cover that in those videos. I do these every day. I do the Market Outlook video. I also put on today's trade idea already before the market closed. So if you want to get to trade idea early before you watch the video here at night, then you can get it there in the live video. Again, you can get it by clicking here on that image, or you can get there by clicking up on this link. And then, of course, our trading rooms that we have. All of our paid subscribers get access to all of our trading rooms and the Market Outlook live videos. Our premium subscribers get access to all of that for free, or for cheaper, excuse me, for a lot cheaper. They also get access to 2 of our Q&A. They get access to 2 Q&A sessions, our class forums, as well as all these. You can see the difference. If you click on pricing, you can see the difference between the 2. Come down here, click on this heart. It opens up a new tab. Hit this like button right there. Hit this thumbs up icon, opens up another new tab. Hit that like button there as well. Again, the more you do that, really helps us out, because the more engagements our posts have, the more engagements our posts have, then the more people will see it. So that's why we always ask for the likes. It also helps you out because Twitter and Facebook will promote content from your timelines, in your timelines, excuse me, from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. And we almost got to 100 likes on the last Market Outlook video. So I really appreciate that, and just hope, ask that you just keep on doing it and just kind of get in the habit of always clicking, even what you can do, like I said, right now while you're watching. All right, let's get back to our charts, and you can see with the rally we had today, it's really helped this candle, this week's candle, be more of a transition candle. You can see the high of the candle is 43.59. We're trading at 43.58, so we got a long and the lower shadows, more of a transition. We've seen that kind of candle before over here, as well as a couple of these others. We might very well end up be producing this type of candle from early February again over the next couple of weeks. Of course, that's not necessarily the case on the Russell. We have had a nice little rally, but it's, again, not even close to getting a long upper shadow. And you can see if we were to close the week right now, we'd open next week at 22.22. We're trading at 22.34, so we would be back to at least a neutral transition candle next week, just like that. So it shows how positive this little 2-day rally is, and how important it is from a weekly standpoint that we hold that rally going forward. Let's take a look at the 3 green arrow chart. We have 1 green arrow. We still have the 2 red arrows down at the bottom. Let me show you what that means. The MACD is still well below its moving average, so it's not like we're crossing anytime soon, but it doesn't take long, as you can tell from there. But there's been other times where we come up and then we don't cross, so keep that in mind. This was actually while we were converging to the upside. The stochastics obviously too is well below its moving average and still pointed lower, so that's why there's still red arrows. But you know, the stochastics, like the intermediate line, you know, it is below 60, but we're not into bearish territory. This was the only time the stochastics got to bearish territory. In fact, if you go back, you know, there's where the intermediate posture started, so you can tell we were obviously in bearish territory there. We've had a few times where we were kind of flirting with that bearish level, right? Just flirting with it. So if I were to edit this, and here, let's go bearish again, make it a dotted line. So that kind of gives you an idea of where the bearish territory is on the stochastic indicator. You can see there's been a few times we flirted with it, but you can obviously tell the intermediate declines, right? When we actually do get below 40 easy, and we don't just drop for a day and then pop back up, which is basically all these other times. We haven't even done that here, so that kind of puts in perspective the type of move we have. If you take a look at this and you think, okay, well, is the Russell 2000, is it in bearish territory? And the answer, as you can see, is obviously yes, right? We are easily below 40. Again, we were that way over here, but we're even more because we dropped below 20, and that's happened last time we were actually in an intermediate decline. As you can see, some of these other times that we fell well below 40. So definitely in bearish territory in that particular indicator. Obviously, for the Russell 2000 or for the CCI and the RSI, we are in neutral territory for the S&P 500. We are actually back into neutral territory for the Russell, even if we're in the lower half of the neutral territory, below 0 and below 50 on that. If you take a look at the DMI for the S&P, we're not bearish because that positive line hasn't fallen below 20 yet. But we're not really bullish either because the negative line is still very high. You can see on IWM that's not the case. Like, we did jump back above 20, but we're still well up here above 30 on the negative. So basically we've had a little bit of a pause in the bearishness of the Russell, and we're still kind of neutral on the S&P 500. Finally, if you take a look at like the Ichimoku trend cloud, you can see we're still a very strong positive trend despite the little weakness we've had here. But on IWM, we're in a bearish, like we're still in bearish trending mode because we're below -2 and we're above 65. So the rally we got up to basically is kind of a make or break move. We either will hold resistance and we got the break above the blue line, we jump back down as early as tomorrow, which is actually what I expect, or we'll break on through that cloud and we'll get back up to the highs again, which obviously there's more than a 0% probability of happening. I believe that's a lower probability. I think the higher probability is that we roll back down now towards these lows and stay on this bearish trend that we're seeing here. And finally, one more thing, taking a look at the Bollinger Bands. Of course, we're still in a neutral zone on the Bollinger Bands, so at the upper end of it in the value area. Again, on IWM, you see the resistance above us. That's another reason why I think we're more likely to roll over than we are to break through, because we got very strong volume resistance up above us here. And to the downside, you can see we are still in the halfway zone. We're in the middle quartiles, but we're in the lower middle quartile. We're still not above the moving average, and there's a good chance we can hold that and bounce back down. Okay, now let's take a look at the intraday moves. And you notice there's the rally up to the 4-week point of control in the S&P 500. I mean, look how stark that move was. Of course, not surprising, it's on declining volume. That's what happens. But you notice now, like if you look at that Arun indicator, that low point's now on the other side of the high tag. It's bearish. It's not as bearish as it could be. It's worse when the red line gets to 100, but that's a bearish crossover. Now, last time we had a bearish crossover, we continued the rally. So there's a precedent right there to see if we continue this move, and I think that's what a lot of people are expecting, is that we'll just now continue that move. If you look at IWM, it's a much different story. We are more bearish there, and the high is way on the other side of the chart. So we're nowhere near getting a new high on small caps. And we are right in the middle. So at the midpoint, we'll see if the midpoint ends up acting as a resistance level as well, the 4-week and midpoint. So again, the volume and the trading range, we saw how extreme the volume was 2 days ago. That's what precipitated the bounce, in my opinion. Look how much the volume has dropped back down. 64 million, the trading range, including the gap here. So yesterday's close, 431. The low at 430, so no gap to account for. So the range dropped all the way back down to 3.69 points on 64 million shares trading hands. So, and for context, we are back below average, and we are right barely above average. So after being extreme, we have fallen back that quickly to very, very minimal numbers with this at 1%. So not really like. Again, we jumped back down the minimal numbers here, but we had some decent volume. You notice we didn't have the extreme volume over here. If I take a look, there we go, this chart. When we had this bounce, you can see we had, it was a pretty decent move, but it wasn't nearly as extreme. And you can see how we dropped back down pretty slow there too, with very small ranges. So we want to see if that ends up being the case here. If we end up getting back to really small ranges again and just really grinding like we did post June expiration. Finally, let's take a look at volatility, and this is telling us an interesting story too. So we're back down to these lows, but the difference is the last time we were at these lows, we were at 17. Now we're at 18. So, and we're coming down from really high levels instead of rising up to these high levels. So you can see, like, again, this is a pretty significant drop. We hit that 95%. This is bigger than the last two bounces we had in volatility to the 95% mark. And volatility is back down to relatively extreme lows just like that. So I think it'll be interesting to see in the next couple of days. I expect that we'll actually bounce back up towards 20 by the end of the week into the low 20s area, and we'll bounce up towards this 90% again. By the time the week is over, then it'll be a matter of whether we break through that and get up to 105%, which would most likely, if it occurred, would be next week, not by the end of this week. So if we stay grinding tomorrow and Friday, then we're probably out of the woods for probably till August expiration. Now keep in mind, from a volatility standpoint, we are heading into a seasonally bullish time of year. July 21st is the lowest point of the year for the VIX over the past 20 years on average. That was today. Now, granted, it's not the lowest point of this year, but it is at a low point, and especially at a relative extreme low point. So now the question is whether we're going to follow the seasonal trends into August expiration with a big burst of volatility that can happen as soon as this next week, going into this weekend. So very important to see what happens this next week. I expect that we'll probably be up here by the end of the week. If we stay down here, then we have a good chance of this grinding again like we saw last time. I think that's a lower probability, but obviously something to kind of keep an eye on going forward from here. All right, so I'm going to break down, how the asset class are performing. I'm going to show you our trade idea of the day. But before I do that, summarizing this technical outlook, we've had a nice little, but we expected a bounce coming out of Monday's market outlook. We got that bounce over the last couple of days. Now I think that's pretty much it. I think we'll probably roll back over going into the end of the week. We do have to be aware of the possibility, and I don't think it's zero. I think there's actually still a decent probability we continue to grind higher again. But I think considering the seasonality, the resistance in small caps, the types of move we're seeing, I think it's more likely, not 100%, but more likely that we'll roll back over into the weekend. Maybe not such a big spark, not a jump up to the 25 on the VIX, but probably a jump back towards 20 heading into next week, which is really another big earnings week. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that make you either a lot more bullish than I am or a lot more bearish than I am? All right, now let's take a look at what's driving this price action. So let me bring up the asset classes. And again, kind of consider here the last few weeks. So let me just let me see where I want to pin this to. So the weakness in the Russell kind of started there July 1st. So it's really been this past month. So let me go since July 1st on this asset class rotation. We're going to change this to July the 2nd. Starting on July 2nd, we'll go out 10 minutes. Kind of go from there. All right. So since then, you can see it's been a little bit of a risk-off move, and you can see going into, let's actually go into Monday. So not today, not yesterday, but Monday. So this is the move that we had coming from July 1st. Small cap stocks down, commodities down, international stocks really lagging behind. Long-term bonds up 5%, gold up 2%, even the dollar was up. So everything, this was a risk-off trade. So if you take a look at the flip side now, just the last 2 days, so we'll go 20 and 21 here, and just look at what we've done here just to last 2 days. Small cap stocks bouncing, commodities bouncing, international stocks bouncing along with US stocks, and bonds dropping, gold dropping a little bit, and the dollar dropping. So it's essentially just a complete reversal of what we've seen over the past month. Nothing more than just an oversold technical bounce. So if I were to now go back to September the 2nd and include the drop and then the subsequent bounce, you can see small cap stocks are still down 4%. Emerging markets are still down 3%. Bonds are still up. And real estate is up. The Qs are up. Remember, the Qs are a safe haven trade right now. Foreign bonds are up. So, and developed market stocks are still negative, and the dollar's still up. So again, it's what we've seen is just an oversold technical bounce, and a lot of the, especially small caps, because they were by far the most oversold, and commodities too. They were just basically bouncing back to these moving averages. Yesterday, bouncing back to the 8-day because we were that far away from it, and then today bouncing to the 17-day. We either roll over from here or we break through. I think there's a good chance we roll over, as I've talked about before, and you can see the same thing on the commodities. We got so far below the 8-day that we bounced back up yesterday, and today we finished it back to the 17-day. We either bounce back down and hold that, or we break through and change and get back to a bullish move. That's the big question mark, whether whether this bounce is a resumption or just an oversold technical bounce. Let's take a look at the dollars chart here, and you can see it's slowing down. You see how we're converging, like we have the negative divergence, and then we started to have we peaked right there on the histogram. We peaked a day later on the MACD. It's been MACD's been converging, but we're still below the 8-day moving average. So the lines are moving together like they do. They did it over here on the positive side. It just slows down, but we haven't started to break the 8-day and or the 17-day yet and change around. So we're just in convergence mode, and I think that at a very important support level that we've talked about ad nauseum in this area here, this multiple Fibonacci zone area. So, and we talked about before too that because the weakness in the dollar started early, it doesn't have to keep going down, or the euro, excuse me, it doesn't have to keep going down for there to be risk aversion, right? The dollar's already pretty darn bullish, and you can see long-term bonds, the same thing. Long-term bonds getting yesterday a real significant engulfing pattern, and then big drop today. And you can see the MACD and stochastics diverging there, starting to roll over a little bit towards and just basically pull back towards these towards their moving averages, and that's kind of what we're seeing play out on TLT. TLT is trying to base here, trying to get through that 200-day moving average, and now after getting through the moving average, we're making a little bit of a return move like we see all the time. And I don't think when we get above the 200-day moving average it will be very long, but you can see about where we'll probably end up getting to 155.50 by the time this particular period of risk aversion ultimately is over with. Taking a look at commodities, you can see, I mean, look at the long lower shadows last few weeks. Those aren't the most bearish. Long upper shadows are the most bearish, but they are still bears. That means the bears are here, right? The bears are now flirting with that 50-day moving average, and there is such a wide gap because we move so far so fast. There is such a wide gap between the 50-day and 200-day moving averages that we can fall pretty quickly down to Fibonacci support without skipping a beat, right? So let's see if I were to move this up here into that area. And you can see also very significant resistance, not only at the 17-day exponential moving average, which we saw previously, but also at the midpoint of the Bollinger Bands and the point of control. And you can see again how easy it will be to fall towards 17, towards Fibonacci support, back towards the March-April weakness. Before that, that sideways action getting down to that area is where I expect we'll get down to during, again, this current period, this kind of nascent period of risk aversion, in my opinion. All right, now let's take a look at how these sectors are performing. So again, going from July 1st period where things started to really roll over on the Russell all the way up to 2 days ago, you can see what the biggest losers were. Energy, big time loser. Financials, materials, industrials, and to a smaller extent, consumer discretionary. They were by far the biggest losers there. So let's look at the last 2 days. What do the things look like in the last couple of days? Well, your biggest winners: industrials, energy initially, industrials, financials, real estate a little bit as well, and consumer discretionary. So the most oversold sectors over the last few weeks are bouncing the most. That's not surprising, right? And you can see it on the 12 grid. These are your bullish sectors, but they're not the ones, they're the most bullish, but they're not the ones leading. It's these areas that led the last couple of days, and they're the weakest, by far the weakest. And you got some light green shading on financials and industrials, and you're back up above the moving average. The question is whether or not that will hold on there. And you can see some big convergence on the real estate after a really bullish move, and we're converging there and converging on XLV as well. If you take a look at their MACDs, you can see the convergence. We peaked in the MACD way over here, a histogram peak there. There's that peak, and we've been converging ever since. Nice little bounce higher, but obviously much lower than what we saw. And you can see the same convergence going on right now. In fact, probably easier to see it on the weekly chart. There is real estate, the histogram peak there, the MACD peak later. Now we're starting to converge. And then there's XLV. Of course, if you look at some of these other cyclical areas, XLK, this is on a weekly chart, XLY, which has been converging for quite a while. We peaked on the MACD over there. We've been converging this entire time. So XLK, we peaked on the MACD over here too. We've been converging, a little bit of a kind of a bigger burst there. And then, of course, XLC, they peaked on the MACD a little bit later, and we've been converging ever since, on a weekly chart, mind you. So that's the mode we're in, and we see that here as well when you look at this chart, at the sector rotation chart. We are in convergence mode on industrials, materials, and financials, and energy, and real estate to a smaller extent. XLK looks really bullish lately. Here, let's go over the last 10 weeks. So, and then I will fit this. So XLK has looked really bullish lately. XLY, not so much. And then, of course, XLP, XLU, and XLRV, of course, are your other safe haven areas. And real estate in an inflationary environment is the most safe haven because it's actually a tangible asset class there. All right, so that brings us to our trade idea of the day. And let's take a look at DR Horton, DHI. It's had a nice little, it has been bearish. This stock has been in its own bearish pullback. You can see the intermediate line's been down below 40. But you notice we made a run into neutral territory previously this month, and it looks like even a stronger run now over the last few days back to neutral. Not necessarily the bullish trend, but at least to neutral territory. If you take a look at the 3 green arrow charts for DR Horton, you can actually see we do have 3 green arrows today, not the spike in volumes. That's why I'm not like too bullish here. You take a look at the 2-line versions of those charts, and you can see the MACD and stochastics crossing, and we have been converging on the bearishness, and now looking to flip around. This is what the long-term chart looks like. we've been converging on the long-term basis, and it looks like we'll probably continue to converge as the bearish momentum is stalling. You can see that as well in the trend strength indicator here, how the bearish momentum is stalling. Like, we don't have that bearish. In fact, we dropped down below 50. We dropped, we're back to almost zero. So we're above the blue line and working our way back towards the cloud there, a pink cloud no less. Looking at the Bollinger Bands, you can see we are trading around a strong volume node up above the value area, back into the upper quartile of the quadrants. And then looking at like the RSI and the CCI, neutral territory for both these indicators, back to the upper half of their charts. And then the DMI for DHI, you can see also back to neutral territory, both lines between 20 and 25, and the ADX down below 20. So very, very neutral trend now. We're not bearish anymore, but we're not bullish either. So that, of course, leads us to making a trade here on, let's see here, so we'll go make a trade on DHI. We will sell the 98 and buy the 100 call option, and then come over here and sell the 85 and buy the 83 call options. You can see what that looks like here on this chart. There's my break evens. That's where those blue lines were. When you look at the blue lines right here, the blue lines have that big volume node centered right in the middle. That will act as a point of, or at least a center of gravity for the stock, as we are grinding away with a really low and falling bandwidth. As long as we stay in this area with earnings coming out tomorrow, as long as we stay in this area, volatility crushes because it's negative vega, then that's how we make our money in this particular trade. Alright, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. All of our subscribers, even our free subscribers, have access to that forum. So open up any new threads with any questions or comments you have about what we discussed. Reply to other people's threads, and let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.